So I've had a couple drinks already. So this week's going to be a little bit more fun for me and probably the listeners than last week.
What are you celebrating?
I'm not celebrating anything, but if we're going to do a show called Drunk Real Estate,
You got to get drunk?
I was always the opinion that we should first drink, Jay and I should drink a bottle of wine before the show starts. And Kyle, you could drink, I don't know, 3 or 4 glasses. And then...
See, I'm drinking bourbon. I give myself a 4-finger pour right off by the end of this episode. I'm pretty good.
and AJ can drink like 3 Red Bulls. He'll be bouncing off the wall.
2 Red Bulls in already, guys.
There you go, bouncing off the walls.
That's right.
Giggity.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, and welcome to episode 2 of Drunk Real Estate. I am Kyle Wilson, also known as Ashley Wilson's husband, and once again, I'm joined by my 3 co-hosts. First, Mr. Jay Scott. How's it going, Jay?
I am doing well. I'm excited to be back here.
What are you drinking tonight?
I am drinking more wine. I'm going with this bottle of Cade Cab. And so, fun fact, one of my favorite wineries, Cade, and my youngest son is named Cade because of that winery.
Well, it's as good a reason any as to name your kid. Mauricio, how's it going?
Not as good as Jay, apparently, but I'm doing good. Doing good.
Yeah, what do you got? What do you got drinking?
I'm going to do this Gary Vee style. I am drinking a Bell Gloss Las Alturas 2020 from Monterey County. It's a Pinot Noir from the Wagner family who does Camus. If you guys are Camus fans, great Pinot. Highly recommend it. I'm enjoying it.
Did you name your kids Bell Gloss?
Bell Gloss is the Wagner's. It's like their grandma or something. Literally, I think her name is Belle.
Okay, and last but not least, we have our designated driver, AJ. What are you drinking tonight?
I'm halfway through my second Ridge Bowl again, same year as last time.
Again, right? I figured you would switch it up. You'd try like Monster, and then you'd do like the zero calorie version, and just maybe give us a review of the different energy drinks.
And there's not that much variety of energy drinks, so trust me, I think I'll get through them all.
Are you sure? My wife drinks that Monster Zero Ultra, and I know there's like 6 flavors of just that. So
yeah, well, like I guess the ultraviolet one's not too bad.
Yeah, that's what. There you go.
Yeah.
All right, so you're double fisting. I got it.
Always.
All right, perfect. Well, let's get into some real estate topics. And first, last week we talked about inflation. This week, in the spirit of the Fed meeting coming up, the only other thing J. Money Powell cares about is jobs. So U.S. job creation remained solid in May, increased payrolls to 339,000, which was once again higher than expectations. I don't know, what is that, 15 times in a row. Revisions to March and April also added 93,000 jobs. The problem is unemployment also rose 3.4 to 3.7. So people are a little bit confused, Jay. How can we have both a strong job creation and rising unemployment in the same month?
Yeah, it's a good question. So for anybody that was paying attention to the jobs report last week, the big headline was that we added 339,000 payroll jobs, which was over 100,000 more than was expected. And a lot of people stopped reading right there. They assumed that the jobs train was just continuing to chug down the track. Everything was great. But as you said, anybody who read a little bit further, they realized that the unemployment rate spiked. Went from 3.4%, which is lowest we've had in decades, up to 3.7%, which is still a good number, but it's a good bit higher than 3.4%. And so the question is, how are both of these true? How did we add 339,000 payroll jobs and unemployment increased? And the answer is that the 339,000 payroll jobs added, it was the main headline, but it was only half of the important story. And the other half of that story is that we lost 440,000 jobs. So now the question becomes, well, how do you gain 339,000 payroll jobs and at the same time lose 440,000 jobs? And a lot of people I hear talking are saying, well, the government's messing with the numbers or something like that. But the truth is there's a logical explanation. So let's talk about this. There are 2 ways that the government figures out their job numbers, and it's common sense. So if you were trying to figure out what was going on with employment, with jobs, what would you do? First, you would ask companies how many people they're hiring. And second, you'd go out to regular people and you would ask them, hey, do you have a job? And how's the job search going if you don't have a job? So basically, the government has these two surveys, and one's called the establishment or payroll survey, and that's where they survey companies about who they're hiring. And the other one's called the household survey. And that's where they literally call up people, regular people, and just ask them what's going on with, do they have a job or are they looking for a job? And because we have these two surveys, we sometimes get different information. And so based on the payroll survey, based on calling companies and saying, how many people did you add to your payroll in May, we get this 339,000 jobs number. Basically, companies said we added 339,000 jobs. But with the household survey, where they called up all these regular people and asked, how are you doing with your job search or with your job? Basically, what they heard was, we've lost 440,000 jobs, or 440,000 people said they've lost jobs. So companies are saying they're hiring lots of people. People are saying they're losing lots of jobs. How does that work? Well, it turns out that these surveys are measuring different things. And the big difference between the two surveys is that the payroll survey doesn't measure self-employed people. So imagine a situation where you have a couple and they own a business. In April, they owned a business together. They were both self-employed. Government calls them up and they both say, we have jobs, we're self-employed. They call up the companies, and the companies say, well, there's 0 people on payroll because they're self-employed. They're not on our payroll. Then at the end of April, they sell their company. They both start looking for jobs. Maybe their company failed. Maybe they sold it. Maybe they just decided not to own a company anymore. And they both decide to go looking for jobs. One of them gets a job. The other one doesn't yet find a job. In May, what we find is that the one that found a job, he gets added to the payroll survey. They call the company and they say, yeah, I hired somebody. I added them to my payroll. So now the payroll survey says we've added one job. But then they call the household, they talk to the other spouse, the one that hasn't yet found a job, and that person says, I'm unemployed. And so now unemployment's gone from 0% in that household to 50%. So depending on the survey, we get different numbers. And in that example, payroll survey says we've added jobs, and the household survey says unemployment just spiked. And so that's basically what happened in May. We had a whole bunch of self-employed people, whether it be entrepreneurs or whether people that were doing gig work like Uber drivers or DoorDash or Etsy, whatever it is, a whole bunch. And when I say a whole bunch, hundreds of thousands of people that were self-employed have decided that they're no longer self-employed and now they're unemployed. At the same time, a whole lot of people decided to get jobs with companies, and so the payroll numbers went up. And another thing to keep in mind, it's not just self-employed. There's another thing at play here. Typically, when somebody gets a job with a company, it adds to payroll. It adds to the payroll number. If somebody gets a second job, it adds a second payroll number because now we have another company saying, hey, I just added somebody to payroll. If somebody gets a third job, now they're 3 times on the payroll. And so it's very possible that these numbers are also indicative of the fact that people are getting extra jobs. And now we actually can see that information in the jobs report. It's not a ton of people getting second and third jobs, but there are definitely some. So when we look at the May jobs numbers, that 339,000 number is a good number, no question. But at the same time, we really lost a couple 100,000 jobs. A lot of self-employed people are now unemployed. A lot of people are picking up second and third jobs. And so the numbers there aren't really good. Now, on top of that, we have a couple other numbers that we can look at. One, average hourly earnings. So basically, how much are our companies paying? Well, turns out that average hourly earnings in May were up 0.3%. Companies are paying 0.3% more in May than they were in April. Problem is, from April to May, inflation was 0.4% higher. So people are losing money with the earnings, with the wages being increased. They're still losing money to inflation. The other thing we're seeing is that the number of weekly hours that companies are reporting dropped to the lowest level since the beginning of COVID back in April 2020. So basically what we're seeing is that companies are cutting hours. And companies cutting hours is a precursor to companies starting to lay people off. It's a leading indicator of companies getting ready to lay people off. So the fact that they're cutting hours is a bad indicator. All in all, that 339,000 payroll jobs added was literally the only good part of the jobs report. Everything else in the jobs report was bad. Unfortunately, for some reason, the media focuses on that one headline, and it obfuscates the real issue. And the real issue is that jobs are not looking good in this country right now.
For some reason, I think it's, that's what's great about this report is it's got something for everyone, right? You've got, if you're pro, the economy is doing great and everything's, just moseying on just fine, then you can look at that top line number, which you mentioned. And by the way, Jay, I thought you just gave an outstanding summary of all sort of the stuff. So thanks for doing that. But Mark, one of my favorite quotes comes from Mark Twain, and he says, "There's three types of lies in this world. There's lies, there's damn lies, and then there's statistics." And I think that's what we're looking at. I mean, the statistics you can really massage. Actually, I don't think the statistics are necessarily lies. They're just your interpretation of the statistics. You're trying to extrapolate that, hey, because this happened, then that means more people are employed or more people are unemployed. When at the end of the day, to your point, the way these things are calculated is really suspect, right? I mean, the official unemployment rate, which is what we call the U3 number, it only counts people who are, actively looking for work, over the last 4 weeks. And so if you are unemployed, but you're not actively looking, or you haven't looked in the last 4 weeks, then you're not going to be counted in that number. And if you actually look at the numbers that the same Bureau of Labor Statistics comes out, and you look at the other numbers that they come out with 6 numbers, as you guys know. And so the U3 number is the one that's kind of the official number that went from, like you said, went up to 3.7. But if you start including all these other people, the people who are kind of so discouraged, they're unemployed, but they're not being counted. They're unemployed. They've kind of given up looking, or they haven't looked in the last 4 weeks, or maybe they're underemployed. Maybe they got fired from their full-time job and now they're doing part-time job, even though they'd like to get a full-time job. All these people are marginally excluded from these numbers. And the recent report, if you look at the U6 number, that number is up to 6.7% unemployment rate if you include all those other people. So there's something for everyone, but I think you gave an excellent summary, Jay. I would just highlight, I think the most important one of those other sort of sub is the amount of hours being cut. I mean, that's now being cut now for the last 4 months. And generally speaking, as you pointed out, that's a leading indicator. I think the statistics I saw that was since they started keeping track, which was, I think, 17 years ago, there's only been 2 times in that period where the hours cut has gone down for 4 consecutive months and we haven't been in a recession. And the reason for that, according to some of the reports that I was reading, especially from the ISM reports, they were saying that, a lot of these employers are kind of hanging on. They don't want to lay people off. They're sort of looking forward to a recovery in the second half of the year. So they're really reluctant to let people go. So they're actually starting to cut their hours versus cutting their employment. But they're starting to get nervous, and they're going to start nervous about whether we are going to have a recovery in the second half of the year or if it's going to get worse. And to your point, it's a precursor to actual layoffs, because if things don't improve, then the next step is not to cut hours. The next step is to actually cut people.
Well, cutting hours is an indicator, but usually you would say the other indicator is job openings. And we have this beautiful JOLTS survey, which I don't think anyone ever paid attention to in the history of surveys until a year ago when Jay Powell started quoting it. But the JOLTS survey is up.
What is a JOLTS survey, Kyle? Just for those
is the job openings and labor turnover survey. So the job openings are apparently higher. So that means that people are hiring more, which to me, we can argue, once again, all these things are based off surveys, right? So you're calling up somebody and you're saying, hey, do you have a job? You're calling off someone, how many people did you hire? You're trusting A, that they're being truthful, and B, like whether or not that information is actually accurate. So it's the JOLT survey. How many people are just posting jobs from 6 months ago and they just leaving them on there? These days, you could just have free job postings. So how accurate is that? But that would contradict the cutting hours if people are opening up more jobs, wouldn't it?
Well, I think we have a couple things at work here. So we also have to take into account this really important number, which is called the labor participation rate. And that's basically the number of people in the U.S. who are in the workforce out of all the eligible people in the workforce. And the number that we're seeing today is pretty much the same number that we saw at the beginning of COVID. It dropped from like 164 million to a lot of people left the workforce during COVID, dropped to like 158 million, and is now back up to about 166 million. And so the number is pretty comparable to where we were, total number of people working, as we were before COVID. But the big difference is we've seen tremendous inflation. We've seen a tremendous amount of demand, which means companies are hiring, companies are expanding, they're selling a lot more. And so they need to hire a lot more labor. And in a normal market, as we see inflation, as we see companies hiring a lot more, they're raising wages and they're attracting new workers out of like from the non-workforce into the workforce. And so we should be seeing that number of people that are in the workforce much higher than what we saw before COVID, and we're not. And so there's just just not enough people that are willing to get out there and go to a job. And I've seen a couple reasons for why this might be the case. Number one, there were a lot of people that were probably on the cusp of retirement when COVID hit. They were 65, 64, 63, 62 years old, and they were probably within a few years of retirement. And normally we see the same number of people or same percentage of people, relatively speaking, that retire each year. But a lot of these people, when COVID hit, said, okay, I'm going to take my retirement early. So people that were 60 years old started retiring when they otherwise wouldn't have retired for 5 more years, or 61 or 62 or 63. And so we saw a whole bunch of retirements back when COVID hit, and those people never entered the labor force again. A couple months ago, I saw this really interesting report that basically said in areas where they've seen or where we've seen the highest increase in housing values, we've seen the lowest recovery or the slowest recovery in the labor participation rate, leading some economists to theorize that there are a lot of people out there that saw their house go up in value since COVID, and we know that's happened in a lot of places, and they basically refied and are living off of that money that they took out of their house, because in a lot of places where houses went up the most, people never went back to work. And so I think that's another thing that we have to consider when you look at how many job openings there are. It's a function of, one, businesses are growing, expanding, and want to hire more people, but there are also more people that aren't ready to come back into the workforce for one reason or the other.
I think we need to zoom out and see the forest through the trees here, because when's the last time outside right before COVID and right now that the unemployment rate nationally was below 4%?
It's not common. It's rare.
It was in right before the 70s. For a teeny 2010, unemployment was quite a bit higher, actually.
Right before the last crash, right?
Yeah, no, it's the last time we saw it was prior to 1970. Dropped below 4%. When you're looking at the economy and the total people working, we are at historical employment rates. And so when you're looking at historical employment rates like this, where 5% is much more what I think would be a normal, right? And we don't want to see above 6%, we start to get into trouble. But having unemployment rates at this level today, it's shocking. And this is causing problems because of the labor market is still, so we have this much, or we have so little unemployment tied to we are still having job shortages. Now, this makes you say the economy right now and the business activity, we're not being able to, the U.S. economy is not being able to supply itself with enough jobs. And we're seeing, we've seen the highest increase in payroll last year since, I don't even remember when. It was, I think, out of our lifetimes. And the Fed doesn't want that. The Fed does not want employment rates below 4%. They need unemployment to rise. And it's one of the few ways they are going to affect inflation. They've got to get unemployment to rise. The business cycle needs to contract. And this is a persistent problem that the Fed is, they're really not sure how to deal with this. And it'll be interesting to see how they handle it. I think, once again, I agree with Jay. I think this would be the end, right? I think we're moving forward to unemployment rising. I think we're seeing the precursors to it. So I'm totally in alignment. I think that this fall, moving forward, because obviously the Fed is going to, if this stays, we keep having payroll increases, inflation's not going away. So historically speaking, we are astronomically low unemployment rates.
Yeah, but AJ, let me push back a little bit because first of all, I think it's unfair that Jay is able to share his screen and show graphs and all that fun stuff when I'm forced to show screen, my phone or whatever. But if you were to pull up, I literally just pulled up the labor participation force, kind of historical, and I didn't get it all the way back to what you mentioned, AJ. But back in 2003, which is 20 years ago, labor participation rate was just over 66%. It was like 66 and a quarter. And then it went all the way down to 60% COVID crash. And then it's recovered some, but it's still below 60.
Yeah, that's because baby boomers. You're talking about the biggest generation of retirees are not working. They're retiring.
Yeah, so that's one of the reasons you're seeing. So remember, unemployment, as you guys know, the unemployment rate is based on two numbers. There's a numerator and a denominator. And the denominator is the labor participation force. And if that's collapsing.
What does this all mean, though? Like when we talk about participation rate and having a job, and like the gig economy right now is so big. Like someone, if they're driving Uber, is that them having a job? Are they participating in the labor force if that's all they're doing and they're working 6 hours a week?
Well, not only that, a gig person like an Uber driver, that I wouldn't be surprised. And Jay, you mentioned it in your eloquent introduction that you may have had a full-time job, a good executive job or whatever, or just a job in general. You got fired, and then you now are working two jobs. One of them is an Uber driver, and another one's you're at Starbucks. So theoretically, you've gained jobs because you've got two jobs now instead of one. But, is that really the job that a lot of people want? But I think the labor participation rate is one of the reasons why the unemployment number obviously keeps going down.
So in 2009, the unemployment rate the retirement rate went from essentially almost 16, like 15.5%, to today at almost 20%. So during that same time, the reason you see that trend in the labor participation rate, it's basically aligned with our population retiring, right? At the end of the day, when we have working bodies we have so many people that are employed, right, and are working that are able to, and this also comes to another problem the United States is going to have for a long, long time. We are retiring more people than people are working, right? And that it's going to be labor issues the United States has never seen. We've never had this inverse weighted of the baby boomers retiring and a smaller generation, bigger in numbers, but as a percentage, right, smaller, trying to replace it. So I think that probably has to do with it.
Yeah, I'd be interested to see what the numbers are in terms of what percentage of the labor participation rate going down as a result of the retirement, the baby boomers retiring, versus also other people that either are just discouraged workers, have stopped giving up. Maybe they've, they made a bunch of money on crypto or the houses, and they don't feel obligated to go work.
I'm a discouraged worker. I don't know.
There you go. Especially today, you're really discouraged today.
Well, you talk about discouraged workers. One indication that I like looking at is actually the jobs quits rate. And you'll notice, so if you want to talk about job wage growth, how quickly job wage growth was happening, the quits rate like absolutely skyrocketed. And that's just the number of people who basically quit their job because they know they're going to get a new one, probably for a higher pay. And so now that jobs quits rate is back down to pre-pandemic levels. So if we don't talk about a normalizing job market, I feel like that's a pretty good indicator as well.
And not to change the subject, but it dovetails exactly with what AJ was saying with the issue that we're going to see over the next 5 to 10 years with baby boomers retiring. We also have another issue, which is I read a headline yesterday that 2022 saw the lowest birth rate in the U.S. Ever. And so this is a longer term issue. I mean, basically, you don't have to worry about like the babies that weren't born last year not working next year. But in 18, 19, 20 years, when basically we're not cranking out babies today and those babies aren't going to work in 18 or 20 years, we're going to have an issue 20 years down the road. And so this is something that's going to need to be solved. And it's a separate issue from what we're talking about today. But I think it brings up a topic for discussion for the future.
I feel like you're steering us into an immigration discussion right now, Jay, and I don't know if I want to get into that.
No, not today, but I think that'll be a good topic for discussion down the road.
I love how Jay's talking about crank. Is that what you do? You crank out babies? Is that the way it works? You're cranking out babies?
Okay. Well, since we're bringing up the government anyway, why don't we take this opportunity to switch subjects, because this was pretty big news, and we have an SEC attorney with us. So the SEC actually there's a proposed accredited investor change, which has been a welcome. Little bit of a welcome move since we've all been calling for it. The accredited investor rules haven't really changed much since like 1982 when they were first enacted. And while there are many proposed changes, it looks like we might finally have something passed through Congress. Mauricio, what do we have going on right now?
Yeah, so just to bring everybody up to speed, just real quick. So, as you mentioned, the accredited investor rules threshold happened back in 1982. And basically, what an accredited investor is anybody who has $1 million in net worth, excluding their primary residence, or have earned $200,000 the last couple of years and a reasonable expectation of earning that much this year. And the reason that's important is they got certain investments that we do in this room. Some of them are limited to only accredited investors. So there's a lot of opportunity out there, a lot of investments that you cannot participate in unless you're an accredited investor. And on the flip side, if you're raising capital and you're buying, like we do, big buildings or self-storage units, then you're limited to investors who are accredited. Now, there's always been debate that, is really the financial threshold, is that really a good indicator of whether somebody should be able to invest or not? I mean, we all know people who have more money than God, and they're the dumbest people in the room. And we all know people who have a modest means who are just brilliant. And so there's always been this debate as to whether, financial threshold should be the mark. And so there's been a movement and a discussion for many, many years. And finally, what happened, actually a couple of years ago now, the SEC came out. The SEC, which, to remind everyone, the Securities and Exchange Commission is part of the executive branch, right? So they're not the ones making the laws. They're the ones that are implementing the law. So Congress passes a law, passes a statute, and then the SEC is the one that's actually tasked with actually implementing that law. And I'm not an expert in government lawmaking, but generally laws are very broad. And so generally when the SEC has to actually make specific rules, they have to kind of figure out all the details. And that's why it takes a little bit longer. But the SEC a couple of years ago came out and said, okay, we agree. And in fact, I just saw a recent press release where they said, yeah, we agree that financial threshold is not the right number. They're not the only way to do it. So let's come up with a test. Like, why don't we do a test where we can actually, somebody can study, can pass an exam, and you can actually get certified to become an accredited investor, irrespective of how much money you make. Everybody was super excited about this a couple years ago, but the SEC has just sat on it since it came out. And this was not a proposed rule. This was actually a final rule that they passed in December of 2020, where they said, we're going to do these tests, or we're going to authorize people, license people to issue these tests. And they've just sat on it. And I think one of the reasons, and not to get political, but the fact is that rule passed under the prior commissioner's rule, Commissioner Clayton. And obviously, since then, we've got a new administration and we have a new commissioner. And it doesn't look like the commissioner is in any rush to do that. And in fact, the SEC under the current commissioner seems intent into actually making it harder for people to become an accredited investor, and actually are talking about increasing, instead of having $1 million in net worth, you may need 2, 3, 4, 5 to become an accredited investor. So really shrinking the pool of accredited investors. And so I think what's really exciting is that Congress now, so the actual body, the legislative body that makes the rules, pretty quickly over the last several months, I did a video about, I actually did it a couple weeks ago, but there were 2 bills that were just made it out of committee. One was called the Accredited Investor Definition Review Act, which overwhelmingly got out of committee with I think it was a 41-2 vote. I mean, bipartisan, like a slam dunk. And then there was another bill called the Equal Opportunity for All Investors Act, or what have you. But the second bill actually made it to the floor of the House, and that bill passed the House of Representatives just last week, and also overwhelming. I think, let me look, 383 to 18. 318 yay votes, 18 nay votes. And so the speed of which this is moving from the Congress side to get this thing passed is really impressive to me. And I'm, based on the overwhelming bipartisan support, I'm guessing that the Senate, obviously it goes to Senate now, and the Senate's going to approve this here probably in the next quarter, 30, 60, 90 days. And it's got such an overwhelming support. I just don't see how Biden doesn't sign it, or if he signs it, they've got overriding veto power on it. So I fully expect that this, since the SEC has just been sitting on their butts for the last couple of years, that this is actually going to become law, and it's going to force the SEC to implement these examinations. And that's what this bill does. It actually provides the authority of one of these regulatory bodies, FINRA, to give an exam. And from what I've read, it's a pretty comprehensive exam. It's gonna test you on your ability to read financial statements. It's going to be testing your ability to understand conflicts of interest. It's going to test your ability to understand what the obligations and responsibilities of the people putting these investments on. So I think it's something you're going to have to study for. You're going to have to go take a course and study for a week or two and go pass some exam. But I think what's going to happen is you're going to be seeing a sort of a divergence. There's going to be two paths now to an accredited investor status. One is going to be the automatic. I'm an automatic accredited investor because I have a certain financial threshold, and there's not only rumors, it's actually on their agenda. I think they're going to be increasing that number, that $1 million number that's currently the threshold. They're going to increase that, and I believe, for a bunch of different reasons we can get into if you want, that number is going to go up to about $3 million. But whether it's 2, 3, 4, 5, it's going to go up, right? So on the one hand, you're going to be able to automatically become an accredited investor on the financial side. But alternatively, if you don't qualify on the financial side, there's going to be a path for you to become an accredited investor via this exam, studying and taking this exam. And that's going to be an alternative way for you to become an accredited investor. So if you're an investor, you're either currently non-accredited, or you're currently accredited, but you're about to become non-accredited because they're going to increase the threshold, and maybe your net worth is $1.5 million, and they're going to raise it to 2 or 3 million. So you're suddenly going to find yourself being a non-accredited investor. There's going to be an alternate path for you to go take an exam and become an accredited investor that way. And the belief is that at the end of the day will increase the pool of investors that are considered accredited, therefore making more capital available for some of these projects. And we can debate all day long whether this is a good thing or a bad thing. There's a lot of people think, well, this is a terrible thing because it's just gets more people who are really not super educated, even though they may pass a test. Obviously, if you're a capital raiser, a syndicator who's buying large apartment buildings or self-storage units or whatever you're doing, it's going to make it your available pool of capital is going to increase. Presumably, we were just talking about this before we went on air, and I did a poll on my LinkedIn page about, are people really going to go out and take the time to study and take this exam and pass the exam? It's going to increase the opportunity to become an accredited investor, but how many people are actually going to go ahead and take that? That's going to be an interesting question to answer. I don't know the answer to that. I think we all believe that if people know about it and want to make investments, they will put that in investment of time to go take the exam. But I think it's exciting, and what really to me is exciting. I know I geek out on this stuff, obviously, as an SEC attorney, but that it's the speed and the overwhelming bipartisan support of these bills that are making it through its way, the legislative process, so that they become law. And then the SEC, which has to implement the law, will have a deadline. And this particular bill has a 12-month deadline. Like within 12 months of this law passing, there has to be an examination option available. That examination option is going to be free of charge, and it's going to be administered by FINRA.
So the question is, do we think it's going to be that easy? Because I actually watched, there was a congressional hearing, I think it was back in February, about the accredited investor definition. They had a bunch of people come on and argue both sides. Some people were saying how it unfairly limits the potential of minorities, and other people were saying basically that the problem is that we have these unregulated securities that there's basically no requirements. The SEC says, okay, if you are only accepting accredited investors, then there's like no financial reporting requirements at all. And so the argument is, okay, if there's no requirements at all, that's putting people at undue risk. And actually during that, the SEC commissioner said, well, if we're going to do that, basically we're going to have some sort of requirement for large private companies to submit audited financials now, and that's a whole other reporting issue. And there was other people, I think the one congresswoman suggested that, having regulations on how much of your net worth you're allowed to invest. And like, there was basically all of these suggestions were thrown out as to how we can change these things. So do we think it's just going to be this easy that, okay, we're going to up the requirement to 3 million, or we're going to be able to take a test?
Yeah. And so the way the SEC typically or always operates is that prior to coming up with its new rules, which again, the rules are based on the laws that are passed by Congress, so that the Congress kind of gives them broad mandate, and now the SEC has to go figure out all the details. But typically the SEC comes out with what we call a proposed rule, right? So they say, hey, here's what we're thinking about doing. Here is the new threshold. So for example, like I said, I believe they're going to come out with a proposed rule. It's going to be a proposed rule. It says, hey, we want to increase the net worth requirement from $1 million to $3 million. Before they make that a rule, they make it a proposed rule, and then they send it out to the people in the industry, and they request comments. So people like me, you, anybody who has an interest, whether it's a regulator, whether it's an attorney, whether it's a syndicator, whether it's a investor protection group, all of these people can actually submit letters and say, hey, look, I think this was a terrible idea because of ABC. Hey, I think
would anyone say that's too low? Who's going to
argue? 3 million?
That? Yeah.
Yeah, the reason this was really interesting is that there was an article that came out on Bloomberg that was basically it was a rumor that said that they were thinking about getting up to 10 million, the network being 10 million. And that caused a huge stir. And it actually ended up being sort of I think a clickbait kind of thing, because that's not what the proposal or even the article was saying. It was just saying if you had a raise that was above $10 million, you had to do certain things. But no, I think the number is going to be closer to 3 million. And the reason I think that is because even if you just remember, the $1 million is from 1982 numbers, right? In 1982, this law passed. They said $1 million. And remember, in 1982, which is now 41 years ago, $1 million actually was real money, right? And so if you just adjust for inflation from 1982 using the official CPI numbers, you end up at about $2.9 million. So to me, just adjusting for inflation from 1982, you get to about 3 million. But maybe not. Maybe it ends up being what could happen. Again, the proposed rule might say 3 million, and there might be all this pushback and all these arguments as to why that's too high or why that's too low. And then the SEC may say they take all that into account, and then they come out with the final rule. It's like, hey, we've heard all the comments, we get it, and here's what we're going to do. I have yet to see, for example, on the final rules that they did about this examination route, there was no reference about doing any other requirements. There was no requirement about, submitting audited financials if you're an issuer or changing anything like that. It was simply, we want to provide an avenue, a test, so that somebody who's actually experienced, 'cause at the end of the day, that's what you're trying to do. If you really are interested in protecting investors, what better way to do that than to make them educated so that they go in with eyes wide open? I mean, at the end of the day, we're all adults. And as long as we understand what the risks are and understand what the obligations are of the syndicators to disclose everything, as long as I understand that, we're all big girls and big boys, right?
I don't know. The money makes a lot of sense because we all know that if you don't have millions, you're dumb. So, why allow them to participate?
Well,
right?
what's the argument? Like, you can't argue both ways, right? You can't argue that people aren't smart enough to be able to make their own decisions, but then also the other argument is what they're saying is, okay, these people have enough money that they could just lose it.
That's the main argument. Like, if you have $1 million in net worth and you invest, not that there's any limitations, but if I put in $100,000 investment and it just turns out I just got, whatever, I didn't know what I was doing because I'm an idiot and I lost $100,000. Well, what's $100,000?
That was the argument the one congressperson was saying, that there's a limit on, you can only invest 10% of your net worth or 5% of your net worth.
That's exactly what we want. The government telling us exactly how much we can invest in and what we can invest it in. This is it's amazing what they come up with. It's so good for the public. They've done such a good job at lowering the wealth gap in the United States with all these regulations.
Well, here's the interesting thing here. So I think what they were proposing before, and this goes to what AJ just said, was if they were to just unilaterally raise the accredited investor definition to 2 million or 3 million or 5 million, there's going to be a lot of pushback. Obviously, there are these people that are currently investing because they're currently accredited, because they're at $1 million or $1.5 million or 1.8 million, whatever it is, and suddenly they change the definition, and these people who are investing can no longer invest. And I guess that brings up another question of, do we have to give them their money back, or are they grandfathered in? But that's a whole separate question. But there's probably going to be a lot of pushback from people who are accustomed to investing in these alternative assets who can no longer do so. But if Congress passes this law that says we can test in to be accredited, it now, to some degree, it gives the SEC cover to say it doesn't matter if it's 2 million or 5 million or 10 million or 50 million, because there's another route. We're not keeping you out. We're just setting a different path. And so it does give them some cover. One thing that I find interesting here is I've always been under the impression that from Congress's perspective that they are hesitant to allow more accredited investors, to allow more people to invest in alternative assets, because what happens when you increase the pool of people who are investing in private equity or these private investments, what happens is people start taking money out of the stock market.
The people that pay them for re-election.
Exactly. And so it surprises me that Congress is doing this, because they really are starting to encourage people to some degree to start moving money out of public markets, which could to some degree hurt the economy, or at least hurt perception of what's going on in the economy.
Because there's no risk in the markets at all. Like everyone who invested in Enron, they did great, or an IPO that swung 50% at the original. Like that's
alternative assets, cash flowing real estate is so much more dangerous than that esoteric bank that you don't know what's doing.
But again, this is perception, and from Congress's viewpoint, they want people investing in the stock market, because the stock market, a healthy stock market, makes the economy look healthy, and so yeah.
That's a great point, Jay, because I mean, clearly Wall Street, look, if you look, I don't have the statistics in front of me, but if you try and say statistics after 3 glasses of wine, if you look at the statistics of how much money has been, invested in the private markets versus the public markets, you definitely see a decline in the public markets. Like the number of IPOs over the last 10 years or whatever has declined a lot. And so I know that there's a lot of lobbying on behalf of Wall Street to basically lobby the rule makers to put a stop to this. And my thinking was, hey, they're obviously lobbying the SEC. They're lobbying, whatever. They're doing what they do best, which is lobbying. But to your point, Jay, like we'd also think, or maybe they just didn't do a good job of lobbying Congress, and they were just focusing on lobbying, the executive branch, and they just kind of let that go. Because you're right. I mean, it's an overwhelming. That's what's really surprised me. The way that these are moving through committees and through the House, it's not even close. I mean, these are overwhelmingly bipartisan. Which tells me that the Wall Street lobbyists have not done a good job in getting to those congressmen.
Here's the one thing that I'm curious your take, Mauricio, and I'm sure you'd just be guessing, but as a syndicator, as an operator ourselves, or at least 3 of us here, the question I have is, now that there are potentially 2 paths to, and let's assume that there are 2 paths to accreditation, one based on how much money you earn or have, and the other based on taking a test, is that going to change the onus on us as operators to vet those investors differently? So, for example, can we still say if somebody's accredited based on how much money they have, we don't really have to worry about vetting them and making sure that they're smart investors and they're doing the right thing? But somebody that tests in that doesn't have a lot of money, we need to do some higher level of vetting to ensure that they're not doing something stupid. Do we have to worry about that as operators?
Yeah, I don't think so. I mean, I haven't seen anything in the proposed rules from the final rules from the SEC or any of these bills that changes the definition, or I should say the definition changes the requirements of the rules. Or, we talk about, not to get too technical, but rules 506C, which allows you to basically advertise and take accredited investors only. There's nothing in the rules or anything that I've seen that indicate that they want to change the verification process. You still have to take reasonable steps, what we call reasonable steps, to verify that these people are accredited. And we actually had the discussion last night on my show that how do you prove that? You're just going to get a certification from the organization. Hopefully there's a database so you can easily just go on the FINRA website and type in somebody's name and it would show up. You can easily use blockchain if you want to do that. But no, your responsibility is going to be to take reasonable steps to verify that they are accredited. And if one of the ways you can be accredited now is an additional way of doing it is to pass an exam, you just need proof that this person actually took the exam and passed it. But it's going to be no different than you taking a W-2 form or a 1099 form to prove income. You're just going to have a certification document that's going to prove that I took the exam and I passed, and therefore, by definition, I'm accredited.
Well, the whole reason that we have these rules is to prevent basically people from losing all their money in a bad investment. And that's a good place to pivot because luckily we have a very good example of that with, I don't know if you've been living under a rock, if you don't know, but everything in the news right now has been this Houston foreclosure deal. So basically what happened was there was a $300 million apartment portfolio that was foreclosed in Houston. It's been going on for a couple of weeks. Why does it keep coming up in the news is the question. Well, first of all, multifamily, it's a multifamily deal, and everyone thought it was like one of the safest investments. And turns out that you could still lose money doing that. Syndication's a hot topic. What we do, raise money from passive investors. And why is it back in the news? Well, first of all, there's a new foreclosure proceeding on top of that against the same group. And B, now the investors are suing this group for fraud. So luckily we have a couple syndicators in this group, an SEC attorney as hosts. So we could discuss both those things. But first, just in case anybody didn't follow this story, why don't we recap what happened? So basically there was a $229 million total worth value of loans was foreclosed upon by Arbor, who's a huge lender, does a lot of agency lending as well as bridge loans. There was 3,200 apartment units and spread across 4 properties. Now, the common misconception was all of these were bought at the same time. These were actually bought in 4 different times, but over the course of 8 months. So that just shows you how quickly this operator was able to accumulate 3,200 units. It went through foreclosure. Actually, no one bought it in foreclosure. The Arbor took it back and then they resold it after that, and took a $25 million haircut on that. So basically what happened was, if we can speculate a little bit, now I'm just basing this off of some of the other articles that I've read, so these aren't my own opinions, but we could speculate that basically interest rates killed this deal. I know I was watching James Ang from Old Capital the other day that where he broke it down that 230 million. If you get that at a 3% interest rate when these were first originated, that's about a 18.4 million. 3% is 6.9 million in what they have to pay yearly. Right now, it's about 8% for the same loan. That's 18.4 million they have to pay yearly. So I don't know what their NOI was, but if you just take what their loan and their purchase price and assume like a 5 cap rate, that means their NOI is only about 15 million. So it's not hard to see the math where at 6.9 million for debt service with a 15 million NOI, that's pretty good. But at 18.4 million for debt service and now their NOI is 15, they're underwater there. They were also high leveraged. I think it was about 77% LTV. They took pref equity on top of that, on top of the 77. So that probably put it way above 80%. As far as how much they had to pay in debt service and pref equity. There's also reports of poor management. This new foreclosure property, I think it had down to 54% occupancy. The city of Houston had 116 separate habitability violations. And they range from electrical violations, uncleanliness, sewage, stuff like that. So obviously management might have been an issue. And one of the big things with this is basically this group was raising money for new investments in February, was turning around in March saying that they needed a capital call, needed more money. And then they took a capital call, and the following month, all of these properties were foreclosed upon. So, It's also reported actually that they were making distributions all the way up till the month before capital calls. So that's obviously a big no-no. So it takes a lot to get all the way to foreclosure, though. We know that there's a lot of steps before that. So AJ, what do you think the worst thing was that led to this foreclosure, or was it a combination of all these things?
Yeah, that's it. How long had they been in the business?
I've heard since about 2019.
Sounds about right. So I think this is a classic tale, I think, of a lot of hubris and expecting the market to bail them out and being really good at a few things like syndicating and structuring bad deals. But I just like to say one thing that took them down. This is a classic, all things, right? They were horrible operators. They didn't structure the deal right. They took on too much debt. It really sounds to me, and from what I know, I'm not a multifamily guy, but I do know a little bit about that market. We're not talking like this market. When we say 54% occupancy and all these violations, everything else, that's not common in that market, especially during this time. So it really stands out in a lot of ways that this was kind of a botched deal from all sides.
Yeah, and a few things to add that I've heard and read, and I'll try and use as many sources as I can here. So number one, I've heard that these were C- properties, and I know we actually knew of a couple of these properties, and these were pretty tough properties in tough areas. And so anybody in this business knows how important operations is and the ability to basically you purchase a deal and people start to celebrate after you buy a deal because, hey, we made an acquisition fee and now we can say we have a whole bunch of units, blah, 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 blah. But everybody that's been in this business for a while knows that's not the point to celebrate. That's the point where the work starts. And it sounds like they weren't up to the task of managing these heavily distressed properties in these really rough areas. According to a lawsuit that was filed last week, so by 123 investors of theirs, it sounds like a couple months ago, and Kyle alluded to this, this group raised $12.4 million that they said was going to be used for a new investment. Instead, they took that $12.4 million allegedly in this lawsuit. They took this $12.4 million and actually used it to try and save these 4 properties that ultimately got foreclosed on. So they went from a situation where they were underprepared, they couldn't handle what was going on, to, if you believe, again, the lawsuit, allegedly, this turned into fraud. So they went from a situation where they couldn't handle the situation, they were in a bad position, and they compounded that with what may be something very illegal. And so I guess that remains to be seen. I also read that earlier this week they were foreclosed on another property, a $65 million loan, which was another property. And something worth mentioning, we talk a lot about these things called rate caps, which are these insurance policies that we buy that kind of protect us from our interest rates causing our debt service to go through the roof and making it too expensive. Kyle mentioned that they got this loan through Arbor. From what I've read, the loan wasn't an agency loan, so Arbor didn't get them a Fannie Mae or a Freddie Mac or a HUD loan. This was actually a loan made through their a debt fund. So this was money that was raised by Arbor directly, which means they didn't have any requirement for a rate cap. I don't know if Arbor imposed one or if they had one. But
even if they did, it would have been the requirements are much more lenient for debt funds than
exactly. So there were a lot of mistakes made here, but at the end of the day, it sounds like they went from bad decision making and tough situations to, again, potentially, based on the lawsuit that was filed, potentially resorting to fraud. And I think that's kind of what separates this from a typical group that's just running into issues with their properties.
Well, the question I have for Mauricio is where does the line get drawn? Obviously, this is taking money from Peter to pay Paul. Obviously, that's fraud. when you're telling somebody you're taking this money to invest in one thing and actually investing in another. But the question that I have is, okay, if you just get in a situation where all of these things went wrong, they just poorly operated these things. They made some bad decisions on loans. They made some bad decisions on management, bad decisions on that. Do bad decisions, can that translate to a lawsuit for fraud, or does it have to be something to the point where they are actually lying about what they're doing?
Yeah, so I mean this is a good sort of fact pattern to sort of discuss, where liability generally comes from. Because obviously there's been a lot of facts that have been thrown out. We don't really know what only the lawsuits will ultimately determine what the facts were. I mean, I've heard a lot of these same stories you have from social media or news. It was in the Wall Street Journal, and so a lot of these we don't really know what the facts are. But what people need to understand is there is a huge difference between, in general, mismanaging a property. So if you're a syndicator, you buy a piece of property and you end up losing investor money, there's going to be a lawsuit from the investors, right? They're going to claim that you mismanaged, that you had a certain standard, what we call the duty of care, right? A reasonable, prudent manager would have done X, Y, Z. You didn't do that. You fell below that standard. So we're going to sue you for negligence, whatever all these causes of action. And you're looking at a civil complaint from your investors, potentially, that you lost money. That's an operational thing. That just happens because as you were operating these properties, the allegation would be that you fell below the standard of care. We lost a bunch of money. We want you to repay us and make us whole. There's also potentially claims of, a securities violation. Hey, you failed to disclose certain things. Maybe you didn't tell us that you were brand new and didn't know what you were doing, or whatever the failure to disclose. Now, I happen to know that, a really well-respected attorney, they had a really good securities attorney involved. So I doubt there's anything going on the security side. But when fraud comes into play, and look, investors are going to claim fraud, intentional misrepresentation. They're going to throw the book at them on the fraud claim. That's going to be standard procedure. But this is all still on the civil. When you get an official fraud, and again, I'm just looking at this BizNow article, but just what you mentioned, Jay, if it's true, and this happens to any syndicator, if you end up raising money for project number one, and you decide that you do your disclosures, hey, we're going to raise this money to put into property number one because that's your property, and you use that money for another property unrelated to the one that your investors own, and that turns out to be a fraudulent, now you run the risk of regulatory bodies, government agencies popping up. The SEC now starts to look at that and be like, wait a minute, does the SEC now? Because if you have a run-of-the-mill failure to perform, the SEC is not going to really get too involved. But if you have now fraud where you're intentionally, if the numbers are big enough, and to be fair, this has been a pretty well-documented case. And by the way, I think this is just the first of many, right? I think this is where the tide is going out. We're going to see who's swimming naked. These guys just happen to be the first ones there. But I'm kind of watching everybody kind of throw stones at these poor guys. And a lot of these I don't think it's just like the banks. I don't think the banking issues are done. You're going to see more banking issues. You're going to see more of these operators and syndicators be, as the tide goes away, you're going to see more issues. But now the SEC starts to get involved and filing complaints for fraud, and potentially even the Attorney General. You can have sort of the FBI come in and say, hey, wait a minute, I want to file some criminal charges against people because now you've crossed that line of fraud. And so that's a line, because now you're talking about intentional acts. It's not like, hey, I did my best, I just wasn't good enough, or I made some mistakes. Hey, look, AJ, Jay, you guys would have done things differently. And if you guys were in charge, we wouldn't have had this problem. But that's not intentional. There's no malice involved. But if you're now, charged with fraud and you intentionally were doing stuff, then you start getting issues with regulatory bodies like the SEC and the Attorney General's office.
So is that a tactic because they know that basically the whole civil route of proving that they mismanaged the money and they did something egregious to try and get a civil case is a tactic to go right to the fraud because it's so much harder to go after the civil case?
Fraud is much harder to even allege. So I haven't looked at the complaint that was filed, this $12.5 million lawsuit that was filed by the 123 investors. But in order to have a fraud claim, you've got to be really specific. You can't just be like, oh, these guys committed fraud. You can be general when you say, look, these guys fell, there was a standard of care and these guys fell below it. that can be broad. But when you talk about fraud or intentional misrepresentation or something that's intentional, you've got to be really specific. So it's much harder to get a fraud claim to stick. It's much easier to get a fraud dismissed. The attorneys will go through a motion to dismiss or whatever, because you've got to be able to not only plead something specific, but then prove it, which is difficult. But once you get into the fraud claim realm, that's when you start to worry a little bit about having the SEC now do its own investigation. And trust me, the SEC will do a thorough investigation first, figure it all out. And if they find that there was some fraudulent activity, intentional activity to defraud investors, they will, I'm talking general now, they will come in and actually file their own civil complaint from a regulatory standpoint. And then the attorney general always has the option to file, criminal charges if they feel it's warranted on the criminal side, on the fraud side.
And here's something that we can actually take as an actionable item and learn from as syndicators ourselves, and anybody out there that's an operator or a syndicator should keep this in mind. We know, because Mauricio is all of our securities attorney. He keeps us in check. So he certainly knows this, but for anybody out there that doesn't have a Mauricio on their team, keep in mind that when something like this happens, things that you said publicly prior to this deal or going into this deal will be turned up. I read I think it was the Wall Street Journal. I took a couple clips from the Wall Street Journal, and just to read a couple of things that they wrote in their article. First, the CEO, I'm not going to say his name, said in a video posted online that he could double his investors' money by fixing up a lower income apartment complex located outside central Houston with a plan to raise rents and to charge tenants extra fees for amenities. Now, I'm not saying there's anything wrong with saying that. I mean, you could argue that if he said I can double your money without saying I could potentially double your money. The point is that in the Wall Street Journal, somebody went and they listened to his investor presentation. They found it online and they started quoting it, which means the SEC certainly has access to this as well. And they're going to hear everything you said. Another quote by the CEO that was quoted in the Wall Street Journal was, quote, "The property value will go up down the road," end quote. And so anybody out there that's done this for a while, I'm sure Mauricio will agree with me that you don't say the property value will go up down the road. Maybe it will, maybe it won't. We don't know. But just saying that is probably, and I'm not an attorney, but sounds like could potentially be a violation of securities laws. And so keep in mind, be very careful what you say publicly. Be very careful what you put in writing. Be very careful what you put on social media, because
or on a podcast. Because if the Wall Street Journal can get a hold of these quotes from you, certainly the SEC can.
Yeah, that's a great point. This is something we hammer clients on, and it's one of the reasons I get really nervous when people do webinar presentations or whatever. But if you're out there, just give you a sort of a pro tip here. If you're out there raising money from investors, just think of it this way. When you do a webinar presentation, when you're on a podcast, when you're doing anything publicly, just think of it as you just did a transcript. Take a transcript of that podcast, a transcript of that webinar, and attach that to your PPM, or your private placement memorandum. That's basically what's happening. So every time you say anything, that's part of your offering information. And so that's why lawyers get really nervous, because we kind of control the environment. We know exactly what to, here's what we're saying, here's the business plan. But when people start going on a podcast or start doing webinar presentations, it's like we have no control over what comes out of people's mouths or clients' mouths. But just keep that in mind. Just pretend that whatever's coming out of your mouth is going to be a transcript. It's going to be printed out into 60 pages of transcript, and we're going to attach that as an addendum to your PPM. But you've got to be super careful. Never use words like will or shall or guarantee. It's always like, we anticipate, we believe, all those kind of like wordsmithing that you want to use.
Yeah, we're getting a little bit long here, so I'll give AJ, you got a final word on this topic, and then we'll move on.
Yeah, I just, at the end of the day, investing is risky, and markets are going to go up and down. There's going to be depressions. There's going to be recessions, right? I think when you look at this particular case, I don't know anything. I don't know these owners. I'm not in multifamily. I'm not in this market, right? But it obviously seems like a little bit of hubris here going into it. But we all have deals that struggle, that underperform. That's part of the game. Investors know it is too. I think it's way more important on how you react to it. That you are being proactively engaged in informing, that you are, showing that you are trying to be a good steward of capital. You're doing everything in your power. I think from what I've read in the newspaper, it feels like people just felt deceived, that they didn't really actually feel like they were knowing what was going on. I just don't think you ever want to be in a position like that with your investors, with anybody else. Things go wrong. Bad things happen. That's how investing works. But how you handle those things is, I think, what really sets people apart.
And I know we're running low on time, Kyle, but there's so many, and I can tell you this from clients who are being approached now to sort of bail out deals that are going south, that there are a lot of syndications out there right now where the LP equity has been wiped out. Like the property's gone down in value. The property's not even worth what the loan is worth, but the LPs still do not know. They haven't been communicated with. They don't know that basically they're at the point.
In some case, they're still even getting distributions.
Maybe even distribution. So again, communication, as my good friend Ken McElroy likes to say, communication builds trust. And when things aren't going well, it's your obligation to double down, triple down, quadruple down on your communication to let them know. Because at the end of the day, they will understand, I think, if you're communicating with them, but sticking your head in the sand and not talking to them. And the reason they find out they've lost their money is because there's a foreclosure. That's not best practice.
And maybe if that communication stops, then that's time to start asking some more questions. All right. So we did a top 10 last week and I didn't get any pushback. So I'm doing a top 10 again. Let's bring it back to the jobs. And we talked about all these jobs being created. But my question was, where are those jobs going? So right now we're doing metro area leaders for job growth year ending April 2023. So rank the top 10. I am going to give points to anybody who could even guess any of them on the top 10. So go.
Government.
Nashville, Tennessee.
Nope. He's talking about industries.
No. Marisa was right. Metro areas.
Have another drink, Jay. Have another drink, Jay.
Cheers.
Cheers.
Wait, metro area is the largest growth.
Yep. Largest job growth change.
Oh, change. Okay.
Yeah. So like I'll just give you the percentage. Number one is 7.1%.
I'd say LA. Somewhere in California for sure.
You can't name a state. That's cheating. You gotta give me at least a city.
Say LA. Wait, LA, Kyle. LA is a city.
He said somewhere in California.
Oh.
I just got to stake my claim, like I call that state.
Austin, Texas.
Okay. So we got Austin, we got LA. What do you think, Mauricio?
I said Nashville, Tennessee. I mean, I don't want to go with the Florida as the obvious one, and Houston is probably on there too. I'm going to go with Nashville though.
No, it's the change. So they're coming off COVID. So who was decimated and then did just a little better? That's good change.
Well, a little better. 7.1% is quite a lot better. I'll give you guys all a second guess because you struck out on the first round.
Who's the closest?
I'll give you one hint. AJ did not hit the right state.
Dang it.
Other than that.
Now we're down to 49 states. Is that where?
Yeah, exactly. No other guesses. All right. Well, you guys are taking too long here. So number one was actually Midland, Odessa, Texas. Number two, Charleston. Number three, Fayetteville, Springdale, Rogers, Jay, which I said we should have invested in years ago. Then we got Myrtle Beach, Fort Worth, and Dallas, which actually are on the list as two separate places, but many places.
I said Houston, so that's close.
Yeah, that's pretty close.
Not
Then we got
really.
Las Vegas, San Antonio, Jacksonville, and Daytona Beach. So Florida and Texas.
I didn't want to go with the obvious ones.
My thesis was totally wrong. I was going off somewhere that just absolutely got decimated in COVID. And then,
Well, they probably this is only 1 year job growth, so it bounced back before that, and then we just saw the natural. All right, now to the fun stuff. We're gonna play the one game. So my question this week for the drinking game is, if you could pick one person and fight them to the death, and if you won, then you get to switch lives with them. who would that one person be? Keep in mind, if you win, that they die. Jay, I've already asked you this before, so you shouldn't be that shocked.
I'm trying to remember who I said.
Stephen Hawkins.
Stephen Hawking?
He's already dead.
So if I pick this person, that person's going to die?
I mean, so listen, he
Why would you want his life?
was gonna die anyways. And then, well, do I have to be in his condition?
Yes, you have to take his life over.
Like exactly. Oh, okay. Well, never mind then.
But that's the point. You get to switch lives with him.
Man, that is hard. I thought, I'll just find somebody that.
If I switch with like Joe Biden, does that mean I become 80 years old? Or
Yes,
am I-
exactly. You take over his life. Exactly.
Yeah, then forget that.
Okay, that's a harder question.
Yeah, so I would go younger than Joe Biden, preferably younger than your own current age, so you can have a little bit of more time, a little more runway.
Who's the most wealthy and powerful person I know with a 10-year-old kid? Take out the 10-year-old kid, I get to be 10 again with all of these resources.
So you're gonna kill a kid then, Jay? Out of all the options, you could take out one of these annoying celebrities, and you're gonna take out a 10-year-old kid.
So you're telling me I should just be Jay's kid? Is that what you're telling me?
All right, hear me out. Elon Musk, no matter what, 50% of the population, right, is going to be ticked, but the other 50% will probably be happy. I think there's, he doesn't work out or anything, so maybe I have a better shot of actually winning that battle. And then I would get to play around with rockets.
Elon himself said you do not want to be me. Like that guy is miserable.
Yeah, well, it doesn't mean that he has to live his life the same way after he takes over his life. It means that you just get his life.
Oh, well, then AJ would take over and then just retire.
Probably, yeah. That's not.
Oh, well, if we can do that.
Once you take over, you can do whatever you want.
Yeah, I could have fun with those rockets.
Kyle, you got to give us these questions ahead of time. You got to give us some time to prep.
Well, okay. Well, so I did have time to prep, obviously. AJ pulled it off. You guys just are quick off the gun, apparently. So I went with Kevin David Lehman, who just turned 21. He's the world's youngest billionaire and is not even working in the company that he is the reason that his family is rich. And I can't find anything on him on the internet. So that means he must not be doing anything awesome. So if I knock him off the world,
I'm guessing a 21-year-old could take you at this point.
I don't know. I'm in pretty good shape, Jay. I work out every day.
You're a former professional athlete. Former,
but this is a 21-year-old who's had billions of dollars his whole life.
That's a good point.
So that's my answer. Jay, you got to give me something. Justin Bieber or something.
Jeez. Okay. Who am I going with here? Jeez.
Oh man, I really support Bieber.
Bieber would have been my answer years ago, but I feel like he's had a decent redemption arc since he got married. Women can change a man.
I can't do this.
Really?
I think I've had too much to drink.
Well, that makes sense. You and Mauricio with your 3 glasses of wine. Are we gonna have to wrap this up without an answer?
Yeah, wrap it up.
Nothing from Mauricio either.
It's at this point in the podcast where I really come strong on these games. I really start winning them at this. I love these games at the end. I have a competitive advantage.
The caffeine's kicking in for AJ and everyone else getting drunk.
That's right.
All right, well, let's wrap this up then, because you guys suck at this game.
Wait a second. I have something to add.
What do you have to add?
We've got stuff coming up next week. Do we want to take any bets on what's going to happen next week?
I'm going to vote first. So next week, what's going to happen is that Kyle Wilson's better half and I are going to be on a panel together at Limitless, and we are going to crush that panel.
No doubt.
I heard they have the worst speakers ever there.
In fact, AJ and I will be holding hands when we do this podcast next week.
Oh, you guys are going to be live together, or not live, but you're going to be together.
That's right.
And AJ is going to shave his beard, and I'm going to grow mine out.
To Jay's point, what's our votes? Are we raising or not raising next week?
100% no raise.
100% no.
Well, you guys are going with the market. 71% chance right now of no raise. Any other predictions you want? CPI predictions?
I think they're going to just say, hey, it's not that we're not raising nothing. We're going to wait for more economic data to come in. I think they're going to put a pause on it.
Yep. Agreed. I'm going to go with 0.3% CPI for May.
So exactly what the predictions are right now. All right.
Is that I don't even know what the prediction is.
Yeah, that's what the predictions are coming in at 0.3 for CPI. So
There you go.
You're really rocking the boat on that one. All right. Other than Limitless, anyone got anything they want to plug before the end of this?
Yeah, I have my event next week.
What's your event? Tell us.
Pace Morby's coming. We're excited. It's going to be awesome. We're going to have a good one. So here,
Is it too late for people to get tickets?
no, you can grab tickets.
Okay, where do they go?
So you can actually just go to my Instagram, AJ Osborne, or you can go to our website. You can go to Self Storage Income's website. Go there too.
What good is having a podcast if you're not going to promote?
Yeah, exactly. The question is, though, do you have to go to Idaho to attend this?
And you get to go to Idaho.
I don't know. Some people were saying $1 billion. You couldn't even stay in Idaho for that long.
Dude, I can't stay in one place. This ADHD kid, I'm like, that's not happening.
Jay, you're not Limitless. You got anything you want to plug?
No, I'm actually home next week for the first time in a while. I've been doing a lot of traveling, but I don't have anything going on until the week after, which I'll talk about next week.
Well, I'll continue to plug my wife. Follow Bad Ash Investor because, once again, she is smarter and better looking than Jay. Well, I don't know about you guys, but my drink is gone. I think I need to go hit the head because this was a longer podcast. So I will see you next Thursday.
See you guys.